How can you have a recession when the unemployment rate is between 4 and 4.5, which most people think is where the natural rate is supposed to be? The second thing is that the numbers are showing that the unemployment rate has gone up because the labor force has grown more than the population. The layoffs are starting to mount up this month, but this is the first month of layoffs that we've seen. So for me, I think the recession calls and the fears in the markets are way overreaction.
And I'm glad you brought that up, Bill, because Alex and I earlier were talking about the latest Atlanta Fed GDP now number for the third quarter coming in at 2.5%. And as you know, that those numbers can be volatile, but still, when you're looking at kind of the trajectory here for economic growth, still looks pretty solid. When you're talking about the dynamics within the labor market and particularly the participation rate, how much does that play into, especially when you see a number drop like that, as far as who's coming into the workforce and who's leaving it?
That's really critical, Jess, and I'm glad you brought that up because as much as people point to the SOM rule and the unemployment rate rising as being a recession indicator, a lot of indicators and historical relationships like that have just not worked so well. How long has the yield curve been inverted, for example? And people have said, "Oh my God, that's always a good indicator that we're in a recession."
Right.
So I think we have to look at carefully at that composition of the labor force, and what we see is that immigration and other factors have and people just wanting to work now because it's easier to get to work, and there are more jobs readily available. So people are encouraged to participate and try to get more jobs. Now, the bad part about this is that consumers have been spending like crazy, as we know, and savings rates have been dropping. Now, the rich people have been dipping into savings, but the median worker and the lower half of the population have really been resorting to a lot of credit in order to make ends meet. And part of that making ends meet is getting a second and third job because most jobs that are available right now are in leisure, hospitality, and sectors in the economy where wages just aren't that high. Mm-hmm. So for me, the real problem out there is the growing bifurcation in the population of rich and poor. And I think we're going to start to see more and more of that as we go toward the election.
I mean, yeah, that K-shaped recovery or economy just keeps getting more K-shaped. Your old alma mater, Citigroup, came out with their call. It's 125 basis points for this year in terms of cuts, 50 in September, 50 November, 25 for December. That feels like one of the more dovish calls out there. Do you think it's an economy that needs that kind of move?
Well, I'm glad we're not there anymore because the need to attract client attention is something that I don't need to worry about anymore. And I feel sorry for Andrew Hollenhorst, who's still in the business of trying to distinguish himself from every other economist out there. I think that's a bit overboard. From my experience at the Fed, I think the reaction at the board and among all the district banks, they'll be saying, we're normalizing the economy. The need for large number of rate increases is really not there. And if we were to do it, it would signal to the markets that there's something to really worry about and that we're panicking. And the need to panic right now avoiding the impression of panicking right now is, I think, paramount for the Fed. So I think we're going to see 25 basis points in September. And maybe if the data continue to deteriorate like this, they'll talk about a more continued set of rate increases and probably hint at 3. But if the data starts to turn around a bit and stabilize and normalize, and we don't see an acceleration in the worsening, I think they're going to say, possibly 2.
Where do you see average job growth coming in over the next 12 months with the expectations that the Fed is going to begin its rate cutting cycle?
Yeah, I think when we look at where the payrolls are weakening, it's exactly in those sectors where the Fed wants it to weaken, the interest-sensitive sectors. In fact, one surprising part of the numbers is how strong construction continues to be. But I think the Fed is going to start saying, if we are successful in normalizing interest rates and normalizing the economy, we'll see payrolls and household employment grow somewhere in the 100,000 to 120,000 range. That's normal. And so everything we've seen up until now at the 200 level is way above normal and not sustainable.
Here's my broad question, also how it relates to tech. These hyperscalers are spending gazillions of dollars, that's a technical term, in terms of spending for AI. Can we have a meaningfully weaker economy with that kind of CapEx spend?
Great point. Because as we see in the numbers this month, one of the surprising sources of job decline payroll decline is in information systems. Now, fortunately, most of that, or almost half of that, is because of broadcasting and newspapers and publishing. But there is a component that talks about where the hyperscalers are. And that also shows a small set of job, the payroll declines. And I think what we're seeing is that companies are having to rationalize their finances and to say, if we're going to spend a lot on CapEx, that means that we're using capital, AI, and other types of innovations to substitute for labor, and especially labor that's very expensive labor. So right now, if you don't have the right skill set in the IT high-tech industry, your jobs are on the line.